Let me tell you, there's one kind of tax that the IRS treats differently from every other kind. And most business owners who have it don't realize that they're holding it until it's already gone personal. By personal, I mean hitting your own tax. It's called payroll tax. Specifically, the money you withheld from your employee's paycheck. What we're talking about is their income tax, their share of Social Security, and their share of medical. That stuff runs through the 941s, and that's filed on a quarterly basis with the IRS. Here's why it's different. Income tax you owe on your personal return, the 1040, well, hey, that's your money owed by you to the government. But withheld payroll tax was never your money to begin with. Your employee earned it. You held it in trust when it was on its way to the Treasury. That's why they literally call it the trust fund tax. And the IRS enforces it exactly that way. And here's how they do it. Faster escalation, less patience. And the one tool they don't have for any ordinary business debt is the power to move it from the business. They will move it from the business to your person. That's one powerful tool they have. We'll get there, but let's go for this first. We're going to talk about how decent businesses end up here, and from there, it's almost never what people assume. Because here's what most people miss. Nobody decides to not pay payroll taxes. It happens in a quarter when everything's going just right. Everything's smooth and tight. Picture a small contractor, say 8 employees, a couple of trucks, maybe 3 or 4. A big customer pays 60 days late. Oops. Payroll day is Friday. The 941 deposit is also due. That's what happened. Now, there's enough in the account to pay one of them. So, if you were a business owner, what would you do? Well, of course, you'd make the payroll tax. No, you'd make payroll. People have mortgages. That deposit can wait. I can hear it in my head. I'll catch up on that next year when that receivable lands. But here's the consequence chain, series of events. Next quarter has its own deposit. Now you owe 2 of them. So at this point, penalties are stacking up. And payroll penalties stack up fast. We're talking on a schedule that gets steeper and steeper the longer the deposit is late. And you've got to guess it, interest is on top. By the 3rd quarter, the hole is deeper than the original problem because you now owe 3 quarters. And the business is effectively borrowing from its own employees and the employees' tax withholding to operate. That's not a winning business. That's a sinking ship. So here's where the IRS starts paying attention. Missed 941 deposits show up on their systems real quick. Now, this isn't a balance that hides for years, like an unfiled 1040. Because it's filed more frequently, it's quarterly. It's reported and it's flagged. Pyramiding. That's their word for it. Stacking quarter upon quarter. And that's one of the patterns that collection people are specifically trained to spot and stop. So now let's talk about what the IRS actually does about it. Because the timeline is not like any other tax debt. Remember, this is the quarterly tax. So with a personal income tax balance, paid annually, and you can sometimes ride that notice cycle quite a while, right? Before any human being gets involved, at least, right? But with payroll tax, things are different. They're a lot different. Trust fund cases get priority because they've trusted you, your employees, to pay. So the IRS is far more likely to assign this to a revenue officer. This is an actual person with the territory assigned to them who can show up at your business at any moment. And they're going to say, "Hi, IRS." Their goal isn't collecting the old quarters. Their goal is to stop the bleeding. You're bleeding. You're hemorrhaging. You're the Titanic. They want current deposits happening now. So an owner who's caught up on this quarter and then negotiating on the old one is a workable case. Are you getting this? Because an owner who's still missing deposits while promising to catch up is, in the eyes of the IRS, an ongoing problem. And that's when enforcement starts to get serious. So levies on the business, levies on the bank accounts, levies on your receivables. They can send notices to your customers. They can seize your bank account. Think about what that does to your business relationships, to your reputation. So Here's the reset. If you're behind on your 941s, the single most important move is becoming current on this quarter's deposits today. Are you with me? Because everything else, every negotiation, every resolution sits on top of that foundation. Because without it, there's nothing to talk about. You're never going to get caught up. Now, the part that separates payroll tax from everything else, let's talk about it. The part most owners learn about, exactly one interview with the IRS too late, the IRS can assess the trust fund portion of the whole tax debt. Withheld tax and the employee share of the FICA, Social Security, Medicare, against individuals, against you as a business owner personally. It's called the Trust Fund Recovery Penalty, TFRP we call it in short. And despite the word penalty, it's not a fine on top of things. It's the trust fund money itself moved onto a person. So your LLC doesn't shield you from any of this. Your corporation doesn't shield you from any of this. Because if you're an owner or officer of a corporation, the entity protections that work for that business do not apply here. Because the law treats this as money you personally held someone else. Call it the trust fund. Two things have to be true for the IRS to pin it on you. One, you were what they call a responsible person. Someone with the status, duty, and authority to make sure those taxes got paid. And second, you acted willfully. And in this context, willful doesn't mean malicious. It could mean that you knew that the taxes were due, paid somebody else instead. You probably paid the rent or paid a supplier before you paid yourself. Maybe you just paid your employees, but that alone can be enough. And once it's assessed against you personally, understand what that means. Your house, your personal account, your future wages are now in the collection conversation with the IRS. This particular tax debt is famously difficult to escape in bankruptcy. Closing the business doesn't end it either because they've now assessed it against you personally. That company can die and the trust fund assessment lives on, attached to people. Here's where people get this wrong. When the IRS works a trust fund case, and when I say works it, I mean they investigate the people who are the responsible people. The centerpiece is an interview conducted on a form called the 4180. That 4180 interview walks through all the questions. Hey, who signed the checks? Who had authority over the bank account? Who had a bank card? Who decided which bills got paid? Was it the accountant? Was the officer? HR? Who hired and fired? Who signed the 941s? And business owners walk into this interview lying. And they do it unrepresented all the time, thinking it's a formality. Let me tell you, this is not a formality. It's the document that determines whose name this debt lands on. Every answer is an input for the IRS. And the net is wider than people think. And by net, I mean fishing net. So it's not just the owner. It could be a bookkeeper with signature authority. It could be an office manager who decided which vendors got paid during a tight week. It could be a spouse whose name is also on the bank account. It could be an investor who got involved in operations. See, the IRS can assess more than one person, and each responsible person can be on the hook for the whole trust fund amount. Let me say that again. The IRS collects till it's been paid, all of it, once. So if you got a letter 1153, which is the IRS proposing the assessment against you personally, you know what I mean. But there's a window to process it, and you can protest it. It's 60 days, and that is a real deadline. Look at the letter. You got 60 days from that date, and it's one of the few moments in this whole process where the whole burden of pushing back is actually structured in your favor. So letting that window lapse because the letter was too scary to open, that's how people end up personally liable by default. Don't let that 60-day window close on you. So let me be direct about what this business is all about. I put this video together because you own or you help run a business with employees. And somewhere between one or a bunch of 941 quarters get unpaid. You've already met a revenue officer, yikes. Or maybe there's an 1153 letter sitting on your desk. Or this one matters most. So think about this. You were near the money, somebody else who just had decision-making authority. And you're starting to wonder if the payroll problem is about to become yours. If that's you, here's the honest state. This is one area of tax that you don't want to get stuck in without representation, where the decisions you make in the next few months can determine the course of your life, whether a business problem stays a business problem, or it suddenly becomes a personal problem, and your personal problem, possibly for you and the people you work with to take care of on your own, regardless of whether the business survives. So who gets interviewed, what records show, and the authority and timing, whether current deposits start immediately, how the protest window gets used, well, those are the important parts. They're not things you want to guess at or make a judgment call on instant. And the decision moment is simple. Trust fund cases reward early structure and punish drift. Every quarter that pyramids, every deadline that lapses, you will suffer. Every casual answer in an interview narrows the path that you can follow. So the owners who come out all of this intact are almost always the ones who engaged with the IRS process from the get-go, while there were still choices on the table. So here's what to do, and in order. First, get current. What does that mean? Get current. Pay your taxes for this quarter. This quarter's deposit on time, starting right now. That is the foundation of every resolution. You got a sinking ship. The first thing that any IRS employee will look at is, where's the hole? Stop the bleeding. Second, get the picture. All 941s filed, even for all the quarters you couldn't afford to pay, and pull your transcripts. You're going to want to know the trust fund portion versus all the rest, because they're treated differently and the strategy that you take depends on it. Third, do not walk into a 41 interview cold. Have an interview. Get prepped. Did you not let that letter 1153 just sit there? Because those two moments shape everything that follows for any business owner. I'm Josh Webskowski. I'm an enrolled agent. I'm admitted to practice before the United States Tax Court, and I'm a fellow of the National Tax Practice Institute. Payroll cases are detailed cases. Authority, timing, bank records. Who know what and when. That's reconstruction work, and that's what I do. Building a factual record that holds up when the IRS looks at it hard. So if you're behind on your 941, or the trust fund letters have just started coming in, well, book a case evaluation. Check out underneath this video. We'll lay out where you actually stand and what's the next 90 days, what that should look like, because you need to go in with a plan. Calmly do these things in order. Calmly, you do these things in order. The link's below the video. And this form, the 941, is quarterly, which means the next deadline is always close. Better to meet it ready, right?